The broadcast is now starting. All attendees are in listen-only mode.
Hello, everyone, and welcome to this Nadex webinar, The Basics of Technical Analysis. And essentially what you're going to get out of this session is a how-to guide to start reading charts. My name is Todd Rich. I am head of education over here at Nadex, and I'll be taking you through this session today. And let's start getting right into it because we do have quite a bit to cover. We've got a lot of folks on today's session, and I know just taking a look through, a lot of folks are brand new to Nadex. It might even be brand new to trading. That might be you, but I want to try to help you move along on your trading journey. Before I jump into it, I do need to share this disclaimer that trading involves risk and may not be appropriate for everyone, that any trading decisions you make are solely your responsibility and at your own risk. And this is an educational session. Please do not construe anything I say as a buy or sell recommendation. I'm doing this, for your education purposes only. And that'll become a little bit more clear when I do what I like to call an off-roading session, where I do a little bit of a demonstration. And I'll try to apply in the platform in a practical way things that we've discussed during the session so that you can see how to do it yourself. I mean, ultimately, that's the goal, is to help you along on your self-directed trading, investing journey. Just a little bit about me. If you've never joined one of the sessions before, or if you're missing out on the morning sessions, I will discuss that further, but we do a live stream on YouTube and on Facebook every morning for about 15-20 minutes. I do that with a partner of ours, Brian Caprice from Keep Trading Simple. We call it Morning Market Movers, but at 7:45 a.m. Central, 8:45 a.m. Eastern, we go for 15 minutes, 20 minutes, and we actually use some of the things that we're talking about or we're going to talk about now, and we look at what's coming up that day in the markets. Where are the hot spots? What is the headline news? And then we jump into some of the markets and we try to apply some of the things that we're going to discuss right now to give people some help in terms of where they might want to focus that day on what markets might be moving. So I will discuss that further, but if you're not doing that, that is something I would encourage you to join. A little bit about me. I did join Nadex back in 2019. I've been in the financial services space for a very long time. I moved out from California. I grew up out there. In fact, you can see I went to school at UCLA, and yes, they're still in the tourney. They're a Sweet 16 team, and hopefully this Friday they beat UNC and make it to the Elite Eight. But I went there for my undergraduate as well as for my MBA. But I was a trader on the floor. I was one of those guys that screamed and yelled and had the funny jackets and the ties. And I did that for 8 years before I moved into the exchange space, working for Eurex, Boston Options Exchange, the New York Stock Exchange for 4 or 5 years, and then over at E-Trade, in different roles, but have sort of moved into this education space where I'm trying to impart some of my wisdom to the next generation of traders. What are we going to discuss today? And I will spend a minute, maybe 2 minutes, talking about who is Nadex, because we have so many folks who are brand new to Nadex. I just want to make sure you're in the right place, but it will give you an idea of who Nadex is and then why what we're about to discuss, which is charts and technical analysis, is so important to trading Nadex markets. And then we're going to go through a little bit of a history lesson. I am going to talk about where technical analysis comes from. I find it helps if you understand what it comes from and what the concepts are behind it. It'll help you understand why you care about any of this. I mean, that ultimately is why you're here, is what is the stuff and why do I care about it? And then we're going to get into how to actually use it. We're going to talk about reading charts. We're going to be talking about certain concepts, which some people are familiar with, some people might not be familiar with, but I want to make sure we're all on the same page. But when you're looking at charts, we're going to be talking about trends. We're going to be talking about reversals. We're going to be talking about support and resistance, all concepts that might be foreign to you now, but we are going to take a look at what those are. And then we'll take a look at there are indicators and drawing tools to help you do your own analysis, to help you do your own homework. I will discuss some of those, and ultimately, I want to get over to the platform and show you. As I like to say, my mom is from the great state of Missouri, or if I'm going to pronounce it right, Missouri. It's the show me state. And I will show you. I will show you how you do this, and I'll give you a little bit on it. I know my colleague Adam McCaden does a full-blown session, about once a month on charts on Nadex, and he goes through all of the features, and he does a full-blown session. We'll spend maybe 15 minutes with it today, highlighting some of the concepts that I'm about to discuss. Now, quickly, I don't want to spend a lot of time with this, but you're here, and in case someone's catching the recording and they're not familiar. Who is Nadex? Nadex is simply an acronym for North American Derivatives Exchange. Now, we are a proper regulated exchange. I emphasize regulated. We are regulated by the CFTC, which is an acronym again for the Commodity Futures Trading Commission. And the reason I mention that is a lot of people come here for binary options, and there are a lot of nefarious actors in the binary option space. Nadex is simply not one of them. We are regulated. We have to adhere to all the rules, regulations, laws of the United States, and we do have oversight, regulatory oversight. Now, what do we offer? And this is what most of the folks here are on this call, is we offer access for retail traders. Retail traders have come to Nadex, and why have they come to Nadex, and why have we become such a large marketplace for retail traders? And that's because we design contracts that have a low cost of entry. You do not need thousands or even hundreds. You can come in with very small quantities of money and access price action in the markets. And the reason you're able to do that is all of Nadex products. It doesn't matter whether you're trading binary options or knockouts or call spreads. And if you're not familiar with those, I would recommend that you join some upcoming webinars that we've got on those products. But every one of our contracts has very clearly defined risk. So you know exactly what you're getting into, and it's a vibrant marketplace, and you know what you're getting into, so there are no surprises, and you can get into that price action without having large quantities of money. And people do come here looking for short-term price action, and the way that they'll analyze and do a lot of this is through technical analysis and reading charts. So what we're going to discuss today will help you, directly, hopefully, along your trading journey. If you're brand new to Nadex, or even if you've been around a while and you aren't aware of this, we do have a refer a friend program. A lot of retail traders like to trade in groups or with friends. If you have a live account, you do have your own personal refer a friend link. And you can share this link either on social media or email it or text it, and you can send it to your friends. If your friends sign up using your link, it's very important that they use your link, and they place 5 trades within 30 days of applying for a Nadex account, you'll get $100 and they'll get $100. You both get $100, and you can do whatever you want with that money. You can do that with up to 10 of your friends. You can end up having $1,000 in your trading account, and you can do whatever you want with it at Nadex. So that's a little bit there. Let's get into technical analysis. So the first thing I'd like to do is a little bit of a history lesson. I think it's kind of fun. I find it rather interesting, but where does technical analysis come from? Now, here's a name. You may or may not recognize the name, Charles Dow. He is often thought of as the father of technical analysis. Now, Charles Dow lived in the mid to late 1800s. Yeah, if you don't recognize his name, he did some pretty significant things during his lifetime. The first of which was he founded a company called Dow Jones and Company. Now that you might recognize. Dow Jones, that name sounds familiar, and there's a reason why that name sounds familiar. The first thing of which they did is Charles Dow did a little newsletter. He built a little newsletter, and back in the day when people looked at news around financial markets, a lot of it was paid for. People paid and they promoted specific things. Well, Charles Dow wanted a news source a newsletter that was independent and that wasn't relying on, say, a company trying to pump its own stock. So he built a little newsletter, and that newsletter became what you now know as the Wall Street Journal. So yeah, that was kind of a big thing that Charles Dow did back in the day. It's now the premier independent news source for really understanding the financial markets. So Charles Dow did that, and then you probably recognize the name from something else that he did. Is Charles Dow, along with his partner Edward Jones, and some of you may have heard of Edward Jones. I know there's a brokerage. I think Edward Jones is still out there. But Edward Jones was a mathematician. Charles Dow had some ideas around the market, and he needed a number, a metric that he could track. And so in order to understand the markets, they put together this thing called the Dow Jones Industrial Average, and it's still one of the main industrial average. It's still one of the indexes, the Dow Jones index, that we still look at. Now, there are other indexes nowadays that people might like better, like the S&P 500, or whether you're looking at the Nasdaq, which is around technology, or the Russell indexes. But the Dow Jones still is an anchor because it was the first one, and it was rather interesting what Mr. Dow was thinking and doing back then. And what he was thinking is he was thinking about a theory. He had some ideas around the principles for understanding market behavior. He wanted to analyze the markets and wanted to put together some concepts. And those concepts that he put together became the foundation of technical analysis. So that is why he is often referred to as the father of technical analysis. Now, what were some of these principles, some of these theories for understanding and analyzing market behavior? And let's just look at a couple of, I'm not going to go through all of them because there are a lot, but the key ones are, number one was efficient market theory. He put forth that markets are efficient. And what does that mean? It means that all news, information is out there, and that once it's out in the public domain, that news gets factored into the price of an asset immediately. So if everything is publicly disclosed in a fair marketplace, the news and information is shared broadly, and that people will digest that information and react to that, such that the price of that asset is a fair price based on all known news, all known information, and that you've got an efficient market. A price of an asset is priced efficiently based upon all publicly available information, so that you could then take that piece of data, all right, you can take the price of an asset and you can put it on a chart. All right. And if you put these price movements on a chart, over time, you're looking at dots that are creating, here's the price of an asset. And, over time, if you have enough of these, that you're going to see patterns form in the marketplace. All right. That you'll look at a chart, and we're going to talk about what that chart, what's put into that chart. But you could look at a chart and you plot the price movement, and since it's efficient markets, prices are going to move, and you're going to see patterns form, and those patterns, the way the price would move, all right, if it would move on news, like there's new news in the market, and that would adjust the price of an asset. But other than that, prices are going to trend based on supply and demand. Right? It's when there's more buyers, than sellers, the price is going to go up. That's demand. If there are more sellers than buyers, they can push the price down. And based on supply and demand, buyers and sellers, that is going to be what causes prices to move. And you'll see these trends when there's more buyers. You'll see a trend happen, and then the trend will shift. Now, why would the trend shift? Because supply and demand shifts outside of a particular news event. And this is what Charles Dow really looked at, is that, hey, if I've got a fair, efficient market, I'm plotting the price of an asset, and that is why he created the Dow Jones Industrial Average, is to look at the broad market. He was looking at the whole market versus one individual stock. He wanted to look at the market as a whole. He was looking for prices trending, and then he was looking for shifts in trends, and then he was looking for these patterns, and these patterns were repeatable. Okay, that's what Charles Dow put forth. Now, in the end, why do you care? And by the way, I am going to interject here now. Is on the right hand side of your screen, there's a little question mark. It has probably has a 1 in it. If you've got questions as we go, this is an interactive session. I'm here live. If you've got any questions, please type them in, and I will do my best to answer them as we go, or I'll address those questions when we jump over to the platform. So I just want you to know that I am here in case I go too fast or I don't explain something clearly, because now we're going to get into why do you care? We're getting out of the history lesson section, and we're getting into the meat of it. But it's fun to do that little bit. So why do traders care about technical analysis, and what is it that Charles Dow was trying to accomplish? And basically, traders are looking to take advantage of reading charts and price patterns. You're looking for those patterns. You're looking at a chart. You're looking for those patterns. And what are you trying to do? You're trying to identify trends. Is something trending up? Is something trending down? And then when might those trends change? I had to be careful there. That's almost a tongue twister. Why and when do trends change? And those are called reversals. All right, you've got a trend, it's going one direction, and then a reversal. All right, the trend stops and starts going the other direction. Sometimes people call those retracements. So I want to make sure that we're all talking the same language. Reversals and retracements can often they often mean the same thing. And then the other thing that you're going to look at is you're not only are you looking for trends, and not only are you looking for potential changes in a trend or reversal, but you're also looking where on the charts, historically speaking, have buyers stepped in, where they give it support. If we're trending down, where might we see some support and see a potential reversal, and then watch it trend up? And then if something is trending up, where might we see sellers come into the market? Where historically have sellers come into the market? That is called resistance. Resistance when it's trying to go higher, but it's resisting because sellers come in. And if you're in an uptrend, where might you see resistance and a reversal where it might start trending lower? In the industry, there's a saying, if you haven't heard this before, the trend is your friend. It's a nice little rhyme, or you don't fight the trend. You might have your own opinion on whether something's going higher or lower, but if the trend is telling you, there's a lot more buyers and sellers and it's trending up, you don't necessarily want to argue with that. Or if it's trending down, you don't necessarily want to argue with that. It's sort of in line with, you don't fight City Hall. You're never going to win. You can't bully the market with your opinion. So understanding these trends and knowing what or trying to understand what other people are thinking can help you in your trading decisions. So in the end, traders use these changes in price to identify these trends, reversals, support, resistance, and it can help identify entry and exit points. All right. So when might you be interested in getting into a trade? When might you want to buy something to go long or sell something to go short? And when might you want to exit that position? So if you got into a trade, when might you want to get out and take a profit? Or if you're wrong and looking at the charts and being able to say, I'm wrong, when might you want to stop your losses? All right, and that is really important. So it's looking at what's going on in the market, looking at the chart, and then trying to identify and help you make trading decisions on when you might want to enter when you might want to exit. And when you're exiting, it's to either lock in profits or to minimize losses in the event that that you're wrong, and you have to admit that you're wrong. And sometimes you'll see that on the chart. You'll go, wait a minute, I'm wrong. So let's talk about charts themselves and how they are constructed. Now, there are multiple types of charts. There are mountain charts, and I could show you the different styles. The most common, the most popular, the one that I think is the easiest to read and understand is a candlestick chart. The other charts have the same components, but a candlestick is just the cleanest and easiest to look at. So let's talk about the anatomy of a single candlestick. And I'm emphasizing a single candlestick because we're going to talk about something else next, which will make sense then, but let's first take a look at a single candlestick. And that candlestick can represent any period of time. And that's what we're going to discuss next is time. But in a single candlestick, this candlestick can represent 1 minute, it can represent 5 minutes, it can represent 15 minutes, 30 minutes, it could be an hour, it could be a daily, it can be a weekly, it could be a month, it could be any time frame you want, and we will get into that. Let's assume for a moment that these are 15-minute candles. Now, what does that mean? Every 15 minutes, you're going to get a new candlestick, and that candlestick will change over the course of 15 minutes, but in the end, you'll get a very clean, here is what happened in those 15 minutes. Now, if you're looking at a candlestick, there are two kinds. There's red candlesticks and there are green candlesticks. Hopefully, and if you're colorblind, there are other charts, by the way, that give you the same information. I will show that to you where it's a little bit cleaner on what's happening so that if you can't differentiate on colors, you get the same information. It's just displayed a little differently, but I will show you that when we jump over to the platform. But on these candlesticks, there's green on the left, there's red on the right, and the color simply tells you whether in that period of time for this particular candlestick, if it's green, it means it closed higher than where it opened. So during this interval, whether it's 15 minutes, 5 minutes, or a day, if it, from the time that it opens to the time that it closes, if it's higher, the candlestick, the body of the candlestick will be green. Now, if, on the other hand, sorry about that, I'm going to take a sip of coffee. If, on the other hand, in that period of time, it should close lower than where it opened, the body of the candlestick is going to be red. So green candlesticks, it's going higher. I think that might be intuitive. And red candlesticks, it closed lower, or it went lower during that period. Now you've got the body of the candlestick, and that represents, the bottom represents the open, the top, the close, if it's green, and vice versa. If it's red, the top is the open and the bottom is the close. Now, outside of the body of the candlestick, you might have what are called wicks. And you can see the wick can go up or go down. And that actually gives you the range that it traded in during that period. So it simply gives you the bottom wick is the low and the top wick is the high. That's the high price during this period. That's the low price during this period. It's the open and close during this period. And if it's green, the close was higher. And if it's red, the close was lower. You get a lot of information in a single candlestick. It's kind of fascinating how they can do that, how you can visually represent so much data in one single candlestick. Now, what ends up happening is if this is a 15-minute chart, every hour you're going to get 4 candlesticks, and that will start to populate your chart. And over the course of 6 hours, you'll have 24 candlesticks. Now, if you drop down to a 15-minute chart, that was that 15? If you drop down to a 5-minute chart, you'd have 3 times as many candlesticks. And again, these candlesticks will represent time is across the bottom, price is up and down the left, and what you end up getting eventually is a chart. All right, now we are going to talk about trends and time frames. And what you're looking at for each one of these is a chart. You can see that they're made up of a bunch of different candlesticks. Now, it's important now we have to talk about the concept of time. Are you looking at a shorter term time frame or a longer term time frame? How close are you looking or how far back do you want to go? These charts that you're looking at down below are all of the same asset. It doesn't matter which asset. And this is the nice thing here is a chart is a chart is a chart. It doesn't matter what you're trading. It's a chart. So this will open up your eyes to a bunch of different potential asset classes if you're going to be looking at charts and using technical analysis. So one, you've got to consider, am I looking at the time frame of my entire chart? Am I looking at the last hour? Am I looking at the last 3 days? Am I looking at the last 2 weeks? Am I looking at the last 3 months? Though that will give you different perspectives on the chart. So how far back do you want to pull your lens and how close do you want to bring your lens? The other thing you need to decide is the time interval for each individual candlestick, because you can have a 5-minute candlestick and be looking at a 2-month chart. It's going to have a lot of candlesticks in there because every 5 minutes you're going to get a candlestick, and that chart's going to be a pretty big chart. If you're looking at 2 months, you might want to drop it down to 1-hour candles because fewer candlesticks might be easier to look at the chart, but it depends on how much, how do you want to take a look at it? How do you want to do your analysis? So the time interval for each candlestick and the date range for the chart are the two pieces of time that you need to consider. And as I mentioned, each one of these charts down below, you can absolutely see how there's different, the perspective on what's happening is quite different. So for instance, the chart to the left, this is a daily chart. All right, I did a daily chart, and when I take a step back and I'm looking at this chart, it looks like it's in a downtrend. You're like, wow, this thing's trending lower. Well, on the longer term, on a daily chart, it is. But when I move into an hourly chart, and you can see this is the right-hand side of the chart now because I'm zooming in a little bit. If I look at an hourly chart, it doesn't. It's kind of going sideways. If I look at the hourly chart and look at what's gone on for the last couple of days, it went down, it went up, it came back down to that price. It's going a little sideways. My perspective and my analysis is going to be different versus the last 5 minutes. I'm looking at a 5-minute chart, and if you're looking at a 5-minute chart, you go, wow, this is actually in an uptrend. So if just to help out a little bit, you can see way down here to the right, yeah, it looks like it's in an uptrend. And if I put this in a 5-minute chart, you'd see that in an uptrend. When I back this up and take a look at an hourly chart in the middle, it's sort of, it's done different things. It went up, it went down, it came back up. Oh, here it came up and went back. It's different. So looking at trends and what time frame are you using becomes critical when looking at charts and trying to do some analysis. All right. And I think I answered the question. If there's any more questions on that, please drop them in. But I think you got it clear. It is both the time of the candlestick, and I will show you that on the charts, as well as how far back I want to zoom in, time frame for the date range. I'll call it the date range so we're not so confused. Time interval for each candlestick, 1 minute, 5 minute, 15, 30, and I'll show you that. Or the date range of the chart. Do I want to be looking at the last couple hours, last couple days, last couple weeks? Okay, cool. Awesome. All right, so now moving on. I do want to start introducing some of the basic concepts. Now, there are so many different patterns that you could potentially see. There are a lot of them. I'm going to give you two. Now, I mean, we kind of look, in fact, if I go backwards here, the first thing we're talking about here is trends, right? We're talking about trends. Is it in a downtrend? Is it in a sideways trend? Is it in an up trend, right? You're looking at a trend here. And understanding how important the time frame is to looking at trends. But the other thing we talked about was reversals. All right, so let's talk about reversals. I'm going to give you two reversal patterns. Again, there are a bunch of different, there are so many different patterns and analysis patterns. I just want to give you a taste, because then you can go out and start doing your own homework, and finding what you like, what you find interesting, what you see, what helps you. And we will talk about that also a little bit. The first reversal I'm going to talk about, it's called a hammer. All right. And a hammer is something you see in a downtrend. You see an asset, it is in a downtrend, it is going down, it is going down. And then you see this one candlestick, and it looks like a hammer. Right? It looks like a hammer. And so if you're in a downtrend and you see a hammer, it could potentially be a buy signal. All right. Now, if you take a look at the hammer, it actually looks like it's got a head up above and it's got a big handle down below. Notice there is no wick up above. A hammer can be red or it can be green. So meaning the open and the close, it could have closed higher and it's a green hammer. It could have closed a little bit lower. It's a red hammer. But the concept here is that sellers tried to hammer it down. Right? They got this long wick down below, but they couldn't sell it. Buyers came back in between the time it opened and closed, and you got this head of a hammer and a long handle down below. Now, a green hammer is a stronger signal than a red hammer, but a red hammer is indeed a reversal signal. But if you see a green hammer or a red hammer, they're both buy signals according to the charts. I mean, I'm not guaranteeing or promising you anything, but this is what you can see, is you'll see these, and a green hammer is a bigger buy signal that you would potentially see a reversal. So again, a hammer, you're in a downtrend, you see this one candlestick formation, it could potentially indicate that you're going to see a reversal or a retracement or a change in the trend from down to up. Now, there is another, it looks very similar. It looks very similar. This is called the hanging man. All right. Now, the formation looks very, very similar, but there's key differences. One, you're in an uptrend. Right? Now, if you're in an uptrend, and then you see this hanging man formation, notice the head of it's a little bit different, it can indicate a sell signal, right? That you're going to see, you're in an uptrend, and you're going to see potentially that this uptrend is going to reverse. And a red hanging man is a stronger sell signal than a green one. And yes, by the way, that's a great question. What if you had an upside down hammer? All right. What if we had the candlestick, the handle of it way above? That's actually called a shooting star. All right. It's take a hammer and turn it upside down. That would also be a sell signal. It's a shooting star. You're in an uptrend. Buyers try to take it out, so you get this big handle to the upside, but there's this body just beneath, so just take a hammer and turn it upside down, or take your hanging man essentially and turn it upside down. If you had a long hammer up above and this little body down below, that's actually called a shooting star. That would also be a sell signal. That is indeed also a sell signal. And that just goes to show that there are a bunch of different chart formations, and there's so many that you can learn. I just want to give you a taste. So we've talked about trends. You see these trends, it trends lower, it trends higher. And then you look for reversals where it might potentially change and give you an idea of when you might want to look for a a reversal, a retracement of the trend, and that might give you an indication to take a trade as well. Now, we've talked about trends and reversals. What we haven't spoken about is support and resistance. And I will tell you, we talk a lot about this in the morning sessions, support and resistance. And again, I would encourage you on those morning sessions to join. I will show you where you can find those as well. But we talk a lot about support and resistance. Oh, and a quick review, a hammer is a buy signal in a downtrend, and a hanging man is a sell signal in an uptrend. And I'll just say an upside down hanging man is actually called a shooting star. That would also be a sell signal in an uptrend. All right, so now let's talk about support and resistance. And this is where we're looking for, where is it in markets that sellers for some reason tend to come in when we look at it on a chart, and where do buyers step in? And when you're looking at support and resistance, here we've got, and again, it doesn't matter what I'm looking at, a chart is a chart. And in this, you could do this type of analysis in any time frame. All right, you can, and so some people like to go, I'm going to look at hourly charts and do some support and resistance analysis, but then I'll drop it down to 15 minutes and also look at support and resistance, and I might find that when they both agree, that's when I want to do my trades. You've got to figure out how it works for you. But you can clearly see that when it got up to this one particular level, for whatever reason, sellers stepped in, and you can put these on your charts and you could draw these and you can say, hey, when it gets this level, I might want to be aware that sellers might step in, and that might be where, and if I'm in an uptrend, I might want to write it until it gets there, and that might be my exit point. Or if I'm in a downtrend, I might see support. So if I'm short something, and I'm looking, when might I want to buy it back? Well, I might be looking for it because when it gets down to this price, you can clearly see that buyers have stepped in. In fact, it got really close right here on this one. Buyers stepped in a little early. It's not perfect, but buyers did, and it was an opportunity. If you had this in your chart, that you might have gone long and had a quick opportunity to make some money, potentially. Now, there is a support and resistance tool. It is a very popular one. If you've never heard of it, it's called the Fibonacci retracement. I will show you how to do this on Nadex charts. And a Fibonacci retracement, it's, and I'm not going to get into the details of it, but it's an interesting one, and it's because it's so popular, I like to talk about it. But Fibonacci is simply a sequence. It's a mathematical sequence. It is a ratio of things that you see in nature. You'll see it in the formation of, say, snail shells, or in a flower. It's the ratio of different parts of the flower to other parts of the flower. It's a ratio we see in the human body, the head to our torso to our limbs. It's a naturally occurring ratio, and since it's a mathematical ratio, we can draw it on a chart as well. And in fact, it's been used when we build buildings. But people will use a Fibonacci retracement. And again, I'm not going to get into the details. If you want to go out and take a look on how that ratio is calculated, you certainly can. But knowing how to use it, when you plot a Fibonacci retracement, it's rather interesting, because I took and I actually should have done this the other way, is I have 100 up here and 0 down here. I could have driven done it the other way, so 0 and 100 are down here, but it's irrelevant because the ratios are still the ratios. And you can actually see how it sort of fits. It's kind of crazy how in the chart at these particular levels, when it came down, all right, and I mean, now it's a retracement, so I had to give it its whole first move. But as it retraced and moved back, it met with resistance at this level. I mean, this level became resistance, and it chopped through it a little bit. And when it jumped through, the next level became the resistance. And then actually, when it pushed through the 23.6 level, it made it up to the 38.2. and it was a selling opportunity. And when it came down, it actually found support. I mean, right around in here. It's not perfect, but it did find support, and it continued to move between these two until it resisted, and it broke through. I mean, and it's amazing how up here to the 61.8 is where it turned around. And what ends up happening, and this is important when you're looking at support and resistance, when you break through, so when, for instance, when we broke through this 50% level, all right, now it didn't work the first time, it completely came down. When you break through, it tends to be a support level, but when it breaks through it, it becomes the resistance level again. When you see it, it gives you some help to look where you, if we were to come lower right now, I mean, notice how we're finding support here. We punched through 50, we got up to 61, now it's finding support again here, 50. If it starts coming off of that 50, you would expect it to come up and find resistance up here at 61.8. If it breaks through this, you'd expect it to find some support either at 38.2 or down below again at 23.6. So again, it's understanding how to use these tools. All right, and I notice that, I mean, and there's something really important that you might have heard in there, and I'm going to talk about that in a second. But these are, Fibonacci is a nice retracement tool to help you find support and resistance levels. And sometimes it becomes a self-fulfilling prophecy when so many people are looking at these tools. Now, I talk about indicators and drawing tools on the Nadex platform. We have a lot of them. When it comes to indicators, there are a variety of technical indicators, and and you've got to find the one that you like. And in fact, one question, I haven't gotten it yet, and I was waiting for it, but I didn't get it yet, is what's the best indicator or the best tool? And the best indicator or the best tool is the one that works for you, the one that you like, the one that you understand, the one that you're able to apply, and the one that when you use it, it helps you be more successful. And everyone's got to figure that out for themselves. Now, some of these tools in here, average true range, it's a great mathematical tool and gives you an idea of how much movement you might expect in a particular asset over the course of a day. Bollinger Bands, if you're into mathematics, and reversion to means. Yes, something will deviate from the mean, but eventually it's going to revert back and come back to the mean. A lot of people really love Bollinger Bands. So, I mean, there are a bunch of different moving average, convergence, divergence. When are you seeing, I mean, and you're looking for reversals in direction based on moving averages. Again, it's a trend indicator. There is some in-platform education, but you can go out and find information and find out which one of these works best for you. Other people like relative strength index, RSI, but we offer a variety of indicators. And we offer a variety of drawing tools. Fibonacci is actually a drawing tool. I will demonstrate that. People like to put in their own channels. They'll look at the chart and it'll help them. I'll play around with that a little bit. I mentioned how we do support and resistance in the morning shows. We actually use rectangles and draw in our own support and resistance lines. So these are all things that you can do yourself, and I'll demonstrate a little bit of it right now. We're getting to that section of the day, but we do have a lot of indicators and drawing tools available on the platform. Now, if I didn't have your attention before, I want to ring the bell and say, pay attention. This is absolutely critical. Absolutely critical. If you're going to start looking at charts and reading charts and trying to understand price movement, there is a very, very, very important rule, and that is caveat emptor. Buyer beware. All right. And the reason I say that is think about every ship on the bottom of the ocean. Think about the Titanic. The Titanic had a chart room. A lot of good it did it. It sank to the bottom. So every ship on the bottom of the ocean had a chart room. And the reason I say that is charts are not 100% accurate. This is not a perfect predicting tool saying this is what is going to happen. It's a tool to help you analyze the markets. There are tools to help you look at price movement. There are tools to help you in making a decision on when you want to potentially enter and exit the marketplace. And remember, entering, you're looking to get into a trade, and exit, it's not just about taking profits, but it's about managing your risk. And that is a very important skill when you are trading, is to manage your risk. All right, you absolutely need to manage your risk. So um, that is the presentation on technical analysis. What we are going to do now is do a little bit of a practical demonstration. If there's anything in particular you'd like me to try to demonstrate, I'll try to, but I'm going to show you some of the things that we spoke about today. If you've got any additional questions, please email customerservice@nadex.com. They're there to help you if you want to learn more about particular tools, or you're having some questions about your account, about the markets, about our products, about the platform. Please email customerservice@nadex.com. They're here to help. I'd also say follow us on social media, the most important of which is YouTube. I really want to encourage you to follow us on YouTube. Now, the reason I say that, in fact, I'm going to go ahead and bring that up right now, is if you go to YouTube and you just go to youtube.com and you can search for Nadex, and you'll find Nadex's YouTube channel. Up here, we have a lot of educational content. All right, we have a lot of educational content, and you can look through it and peruse it at your leisure. You can subscribe to our channel. I would encourage you to subscribe, because then you'll get alerts. Hey, they just posted content, or you'll get an alert when we're about to go live. Now, I mentioned every day. You can see that our CEO does a very quick 1 to 2 minute headline news every morning. Today he was on for a minute and a half, and you can catch those. Yesterday he was on for a minute and 20 seconds. Travis does a great job of doing a quick hit on any headline news and what might be moving. But these morning market mover sessions, these are longer. We go 15, 20 minutes. Again, I do that with my colleague and my partner, Brian Caprice from Keep Trading Simple. And you can go back and listen. So if you actually go here and you look at, instead of when I'm on the video section, instead of uploads, you can look at upcoming live streams, and you can set a reminder. I usually keep them out there for about a week, so you can remember that we do this every morning, 8:45 a.m. Eastern, 7:45 a.m. Central. If you miss it and you're not able to join, they're immediately up on our YouTube page, and you just go to past live streams. And in fact, you can go back and listen to what we had to say today, which wasn't a lot because it was a quiet morning. But you never know what morning, when things, if there's headline moving news, if there's economic reports during that day, what happened overnight. And we do go through and look at support and resistance and technical levels and things of that nature. It can help you where you might want to focus each morning. So I would encourage you to do that on Morning Market Movers. That's the Nadex YouTube page. Now let's jump over to the platform. And someone did type in gold, and it's kind of funny because I had it up here. I could do this with any of these assets, but I'm just going to go ahead and demonstrate some of these. Let's go ahead and move our order ticket out of here, so it gives me a little bit more chart. A demonstration. You know what? We can probably even get this out of the way, and let's just take a look at a chart of gold. Easy enough. Notice up here in the upper left-hand corner, I could change. Do I want to see an hourly chart of gold? All right, and I could take a look at an hourly chart of gold, and we could see what gold has done. And notice this takes us back into February, and you could see gold went on a wild ride. I mean, it went all the way up. It punched higher, almost got up to 2,100 an ounce, and came all the way back down to $1,900 an ounce. I mean, if we keep going back further, I mean, I know that gold came from $1,800 an ounce. I mean, this was inflation, and now it's the Fed's going to start raising interest rates. That's going to harm the price of gold. But you can see how on a 1 hour chart, and I go all the way back. I mean, this takes me back to the very beginning of February. So this takes me back almost 2 months. You can see how the chart of gold looks. Very different than if I say a 5-minute chart. Let's come in, and I just look at the, a 5-minute chart. I only look at the last couple days. The last couple days, gold's actually been trending up. So the time frame and the date range on your chart is going to make a difference. Now, I mentioned some of these tools. Let's actually take a look at, let's instead of making this 5 minutes, let's make 15 minutes. I like 15-minute charts. And you know what we're going to do? I'm going to, let's take this, whatever I did on here off. Let's delete that. I know I could do this. There we go. All right, so the first thing I'm going to use is, let's take a look, and up here in the left-hand corner, or I can right-click on the chart. If I right-click on the chart, I'll get all the same information, but I'm just going to go ahead and go up here to the left-hand corner. And for drawing tools, the first one I would like to show you, because it is popular, is the Fibonacci retracement. All right, and again, if you're not familiar with Fibonacci, you can take a look. But if I click on Fibonacci retracement, I can see that gold was high up here and this was the low. So I'm going to start in the upper left-hand corner and click once. I'm going to drag it down to the low and click twice. And then I'm going to drag it over to the right. Okay, and I clicked a third time. Now, using this Fibonacci retracement, I might see some levels where there are support and resistance. And what's really rather fascinating is I'm going to grab that rectangle tool, and we can see that this price right here was resistance, resistance, resistance. All right, and this is amazing. I mean, I'm doing this now for the first time, and we're just taking a look at it. As gold dropped from, this is the high to the low, as it started retracing, notice that there was resistance right here. So let's actually put that resistance line in. Let's draw another rectangle on here. And we see that we've had some resistance here. All right, it met resistance at this 61.8. When it came back down, it found some support at 38.2. When it came back up, it met resistance at the 50% retracement. Notice that it came back down and found some support. I mean, this is another level. I mean, look at this. I'm just going to draw these levels on here, and you can see how it would have potentially helped you to make buy and sell decisions on these Fibonacci retracements, support and resistance. Up here, it met resistance. Down here, it found support. On the way back up, it had resistance, resistance, resistance. It came back down. It found some support. It went up. It had resistance, and it punched through. It found resistance, and now this becomes support, 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 and it took off again. Now, if gold were to turn back, if gold were to go higher, I might, if it's able to get through, look at this, it's having resistance at the 76.4. If it gets through 76.4, I might think it could potentially retrace all the way and complete the journey. So I might be looking for it if it gets through here. If it doesn't get through here, all right, if it doesn't get through here, I might look for, if it starts coming down, I have two levels where I might be looking for support. And if it gets through this one and it keeps going, I was wrong, get out, and you might then wait and look for some support here, where it might be a reversal. So again, not perfect, but it does give you some help, some guidance on where you might want to look for support and resistance for buy and for sell levels, whether you're getting in to initiate a position with a short or a long. So I mean, this right now, this is a short position. Hey, it's going to meet resistance here. We're going to sell it, look for it to come back a little bit lower and buy it back. Or where you might want to initiate a long down here. I might want to go long. If it gets down to here, I might feel comfortable that it's found some support. This was a resistance level before. 1, 2, it resisted. After 3, it broke through, and it's challenged this once, twice. I might look for it to support again before it bounces off. So it can help you make some decisions on where you might want to look to potentially buy, where you might want to potentially look to sell, where you would, if you're wrong, where you would say, all right, cut bait, get me out of this trade, I'm going to take my losses, and where might I then initiate my next position. So that's Fibonacci. Let's jump to a different asset. Let's take a look over at indices. Let's just go ahead and grab the S&P 500. I'll grab the S&P 500 chart. Let's just populate the chart. Let's get rid of this. Let's get rid of this. We can leave it with 50. You know, let's just see what else we've got. Let's go to a 30-minute chart. All right. Now, I mean, there's other things that you can be doing. For instance, I mentioned, well, I mean, you can actually see, and I don't like how it's not giving, you know what, this is something we're doing new. It's now giving us these Saturday and the Sunday on here. A lot of times you would see those out, but we're moving toward eventually having 24-hour markets. So, but let's take a look at channels. I can build a channel in here. You know, I'm just going to try to put a bottom end of the channel and a top end of the channel. This also could help you look for levels on, I've got this channel built, and if I get near the upper end of the channel, it might be a sell. And if I get near the bottom end of the channel, it tends to be, you know, it could be a buy. So channels are one way for you to take a look, something different than, and what people will often do is they might use two indicators, you know, and look for confirmation. Now, what I will tell you that you can use too many indicators. If you put a bunch of things on your chart, like I can go crazy and do something like this, and then drop on this, and yeah, can I make my chart too crazy that I don't even know what I'm looking at? For sure you can. So, you know, I would say, you know, it's kind of funny how two of these look like they fit and one doesn't. So again, the best indicator, the best tool is the one that works for you, that you are comfortable with. But you can see how you can apply different indicators to the charts, and they might help you identify potential buy levels, sell levels, entry points, exit points, whether those exit points are taking profit or whether they're limiting losses. I want to thank everyone for joining this webinar today. It was recorded. It will be available on our YouTube page, so it will go there. It'll also be available on the Nadex website in our archive section under webinars. You go to learning, webinars, and into the archive. But again, we put a lot of educational content out there. Thank you so much for joining. I hope that I catch you at those morning sessions, because I think you'll see some of this being applied in the markets, and it might help you with your journey. And if you're not able to join, you can certainly catch those recordings later. With that, good luck in the markets, everyone, and I will catch you next time.